Thinking of exiting your business or taking on a private equity partner to help you grow faster? BizNexus has you covered. Tap into our network of thousands of best-fit investors, acquirers, and proven M&A advisors, and we'll help you begin the relationship confidentially on your terms, your timeline. Learn more at biznexus.com.
Disclaimer from the always present legal team. Podcast conversations don't necessarily reflect the views of BizNexus Incorporated. Everything you hear is informational news and updates from around the industry. We're not recommending any investments. We're not offering any investment advice. Be sure to do your own homework.
Today, we're grabbing the financial blueprint for M&A. We're looking at that crucial moment when the deal is signed and the money actually changes hands.
Right.
You've just spent, millions or maybe even billions on a company, but what are you actually allowed to put on your own balance sheet? We are diving deep into purchase price allocation, or PPA.
And PPA is really where this high-stakes world of corporate strategy meets the grinding reality of financial rules.
Yeah.
It sounds like some kind of obscure accounting jargon, but really it's the process that turns a handshake deal into an auditable, standardized financial reality.
So our goal for this deep dive is to unpack the core mechanics of an acquisition. We're talking about the assets, the liabilities, and that enormous and often controversial premium that's known as goodwill.
Right.
We want to show you exactly how the value of an acquired company gets defined, measured, and then ultimately reported. It's all about understanding the critical financial mechanics that underpin every single major transaction.
And for this, we're pulling our insights straight from an exploration of M&A dynamics. We're focusing specifically on the kind of rigor that's required in the lower middle market deals.
Okay.
And our source for this is our friends over at Private Equity Bro. They remind us constantly that transparency, it all starts right here.
So let's start with the hard definition. If PPA is mandatory, what is its primary function?
Well, purchase price allocation is mandated under financial reporting rules. In the U.S., that's primarily ASC 805.
Right.
And its fundamental purpose is, it's all about ensuring accurate financial reporting, robust tax compliance, and transparency for all stakeholders.
Okay.
It requires the acquiring company to identify all the assets and liabilities of the company they bought, and then confirm their fair market value at the date of the acquisition.
So it's the rule book.
It's the rule book. It's how you transform that one single transaction price into structured, itemized entries on the balance sheet.
So if the price tag is, say, $100 billion for the whole company, we can't just write down a single $100 million line item.
No, absolutely not.
We have to dissect it. So what are the three foundational building blocks we have to allocate that price across?
PPA always revolves around three key components, and they have to sum up to the total purchase price.
Okay.
First, you have the net identifiable assets. That's the tangible stuff and the recognizable intangible assets. Second, you have the liabilities the acquiring company is assuming. And finally, the balancing item, the calculated residual value, goodwill.
And the goal here is that this allocation should reflect the true economic reality of what was just bought, right?
Absolutely.
Yeah.
I mean, if you get this allocation wrong, you are essentially misstating your financial position for years to come.
You could mislead investors.
You could mislead investors. You could mislead the market about the profitability and the real value of your underlying assets. The whole point is to reflect the true value of the acquisition.
Okay, so let's walk through the steps then, because this gives us the framework for the whole deep dive. How does an accountant actually execute this?
It follows a pretty rigorous four-step process. So, step one, identify the purchase price and any necessary adjustments.
Adjustments like what?
Things like transaction costs or contingent consideration. That gives you your total budget for the allocation.
I mean, that's the total number.
Exactly. Step two, determine the fair value of all identifiable assets. This is where the hard work really begins, valuing everything from, real estate to customer lists.
Right.
Step three, assign values to the liabilities that were assumed, like debt or deferred tax liabilities. And finally, step four, calculate goodwill as the residual. So you take the purchase price from step one, subtract the net assets and liabilities from steps 2 and 3, and whatever's left over. That's the premium. That's goodwill.
That makes the structure really clear. Now let's talk about step 2, because that feels like where most of the complexity and maybe the risk is.
For sure.
Especially in the modern economy. I mean, if a private equity fund in the low and middle market buys a manufacturing plant, they know the value of the machinery.
Right, you can kick the tires.
Exactly. But if they buy a SaaS company, the values and things you literally cannot touch. We're talking about intangible assets.
And that's the strategic pivot of contemporary PPA. Intangible assets. They're non-physical assets that provide demonstrable value to a business, and they contribute to its competitive advantage.
So they're the real drivers of success.
They are, in innovation, in technology, in knowledge industries. These are the drivers of long-term success, far more than physical property is.
So what are some tangible examples? What does the PPA process force companies to pull out and value separately from just general goodwill?
We're talking about assets that meet specific criteria. They're either legally protected or they're separable and transferable.
Okay.
So this includes things like patents, registered trademarks, proprietary software, valuable customer lists, and even non-compete agreements signed by key executives.
And they're essential to quantify because they have, what, a finite life?
A finite life, and they provide measurable future economic benefits. That's the key.
You mentioned future economic benefits. So if a strong brand creates customer loyalty or a patent blocks a competitor, how do you translate that advantage into a concrete dollar value for the balance sheet?
This is the real challenge. Because unlike tangible assets, intangibles almost never have a clear, active market where similar items are bought and sold.
So what do?
You have to rely almost exclusively on what's called the income approach for valuation.
Okay, let's unpack that approach because this sounds like where the subjectivity starts to creep in.
It is. The income approach is, at its core, an exercise in forecasting. You have to estimate the present value of the future earnings that specific asset, let's say that customer list, is expected to generate over its useful life.
So you have to separate out the cash flows just for that one asset.
Exactly. You have to separate the cash flows attributable solely to that asset from the cash flows of the rest of the business.
Yeah.
It's a very difficult exercise.
Wow, that sounds incredibly sensitive. If you're forecasting cash flows 10 years into the future, and then you have to apply a discount rate to bring it all back to today's value, I mean, small changes in that discount rate must completely swing the valuation.
Precisely. That's exactly the point. If your calculated discount rate moves from, say, 9% to 11%, which is a seemingly small administrative change, the entire net present value of those future earnings can just drop dramatically.
And I imagine auditors spend a ton of time on that.
Oh, they do. They spend so much time scrutinizing the cash flow assumptions and the weighted average cost of capital used in these valuation models. The valuation itself is inherently a measure of future expectation, not confirmed historical cost.
It's just fascinating that the stability of a company's financial report after an acquisition rests entirely on a forecast that was created before the deal even closed.
It raises a really important question. If the projections used in the PPA are, highly optimistic to justify a high purchase price,
Which they often are.
then the resulting intangible values are fragile. If those projected benefits, the loyalty from the customer list, the revenue from the patent, if they don't actually materialize, the asset value is overstated from day one.
Which brings us perfectly to the big residual, goodwill. So we've valued the easy stuff, the physical things. We valued the identifiable intangibles. Goodwill is step 4. It's the amount left over. Why is that residual value usually so large in modern M&A?
Well, goodwill is the premium paid over the fair market value of the company's net identified assets.
Okay.
So if the buyer pays, say, $150 million for a company whose identifiable parts only add up to $100 million, that $50 million residual is goodwill.
It's basically an acknowledgement that the company is worth more together than just the sum of its isolated parts.
Exactly. It's paying for the future potential of the combined entity.
And what does that potential reflect?
That premium reflects things like reputation, an established market position, the inherent strength of the workforce, and most importantly, the synergies expected from the business combination.
The idea that 1 + 1 will equal 3.
That's the idea.
Yeah.
The hope that once the companies merge their operations, they'll be more valuable together.
That does sound subjective, though. Isn't goodwill just a giant plug figure that justifies a high valuation rather than a truly measured asset?
That is the critical, skeptical view that many people take, and it's why it's so heavily scrutinized by auditors.
Right.
While it is calculated as a residual, the drivers that justify that high purchase price, they have to be documented. Our sources detail the primary factors that influence this premium.
Like what?
Things like a strong market position, an excellent brand reputation, established customer relationships that aren't, separable enough to be their own asset, anticipated cost or revenue synergies, and just overall growth potential.
So if a buyer pays a premium because they believe they can save, say, 10% on operating costs through synergies, that belief is monetized and put right onto the balance sheet as goodwill.
Correct. But that brings us to the consequence of failure. Goodwill impairment. Since goodwill is non-amortizable, meaning you don't gradually write it down over time like you would a patent, it has to be tested annually for impairment.
So if those synergies or growth potentials don't pan out?
If they don't pan out, the acquiring company has to perform a massive non-cash write-down. They have to admit that the value they paid for no longer exists.
And we've all seen those enormous impairment charges from big companies. They often trigger massive drops in the stock price.
Because it's a signal. It signals that the initial PPA, the initial promise of the deal, was fundamentally flawed.
It's the ultimate reality check.
It is the moment the market learns that the initial forecast was wrong.
Okay, let's pivot to the practicalities. If you're executing a deal in that lower middle market space, what are the biggest stumbling blocks when you're allocating value across these different buckets?
Well, beyond the inherent difficulty of the fair value estimates for intangibles we just talked about, you also have significant external pressures. You have to consider prevailing market conditions.
How so?
I mean, if the market for that company's technology shifts between the agreement date and the closing date, your valuation assumptions might be instantly obsolete.
Okay, that makes sense.
You also have regulatory requirements that dictate what can and cannot be considered an identifiable asset.
And the promised synergies themselves must complicate things, right? Because the value of one acquired asset is often dependent on how it's integrated with the acquiring company.
Absolutely. Those synergies and interdependencies make a clean segregation very, very difficult. For example, how much of the value of the acquired company's sales force is because of their existing customer relationships versus the new sophisticated CRM platform the acquiring company is about to give them?
Right.
The valuation just can't happen in a vacuum.
Okay, let's finish with the crucial practical angle. Taxes. Getting the PPA right isn't just about GAAP compliance. It's a critical component of post-acquisition tax strategy.
This is arguably the most strategic part of the entire PPA process.
So how does PPA impact the taxes the combined company is going to pay?
The allocation determines the tax basis for all the acquired assets. And critically, you have to look at the difference in tax treatment between goodwill and the identifiable intangible assets.
And what is that difference?
Generally speaking, identifiable intangible assets like patents, copyrights, or those customer lists, they are amortizable for tax purposes.
Okay.
Which means the company can write off the value of that asset over its useful life, usually 15 years, and that creates a non-cash expense that reduces taxable income.
So the higher the value you can justifiably place on those identified amortizable intangibles, the lower your company's tax bill is going to be for the next decade and a half.
Precisely. Conversely, while goodwill is non-amortizable for financial reporting, its tax treatment can vary. If the transaction is structured as an asset purchase, tax goodwill might also be amortizable. But in many stock acquisitions, it is not.
So there's a huge incentive there.
A massive financial incentive. It's a strategic battleground, you could say, for management and tax advisors to push for the maximum plausible allocation to those amortizable, identifiable intangibles and away from non-amortizable goodwill.
It's that constant tension between the accounting rules, which demand accuracy, and the tax department, which demands optimization.
And the PPA process is where that tension plays out. That strategic allocation directly influences the combined company's depreciation or amortization schedule, which directly affects future taxable income. Getting the PPA optimized is key.
So what does this all mean for you? We took this high-level concept of an M&A deal, and we broke it down through the structured rules of purchase price allocation. The big takeaway is that PPA is the forensic accounting required to prove that the valuation paid was justified. It reveals that the real deep dive in modern finance is often into those non-physical assets. The brand, the synergy, the customer loyalty that truly drive future growth.
It forces sophisticated buyers to quantify what they hope to gain rather than just what they currently possess.
Which is where all the risk and the enormous opportunity resides.
And that leads to our final thought for you to consider. Since the entire reported value of an acquisition, especially those substantial intangible and goodwill figures, fundamentally rests on predictions about tomorrow's success using the income approach. The balance sheet value is really an artifact of expectation. So this raises the essential question. How much should we really trust a multi-million or multi-billion-dollar balance sheet number that is primarily a calculated measure of future potential? And how long does it take for the market to realize those underlying forecasts were either genius or fantasy? That volatility is why PPA is so much more than just accounting.
Acquiring a business? BizNexus simplifies it. Access thousands of updated opportunities in our DIY marketplace or supercharge team sourcing with OmniSource, your all-in-one platform for on-market, off-market, and coming-soon deals. Scale smarter today. Learn more or book a demo at www.biznexus.com.